In today's video, we will value a company called Array Technology. For a bit of background, I've been very vocal regarding the valuation of this company. And in today's video, I will take that further by demonstrating the reason why I've believed and that I still believe that Array Technology is grossly undervalued. I bought Array Technology share when it was trading around $10, and I still believe that we are not done yet. Our first video on financial modeling and valuation was Tesla Motor, and we evaluate Tesla Motor using dividend discount model. No, using a discount cash flow model. For Array Technology, we will use a model that I like, that I personally enjoy, which is the residual value model. For those of you not familiar with my work, welcome to the analyst. So first of all, it is important to discuss about the residual value model itself. I like the residual value models because I've always believed that the market value of a company is a combination of three factors. First, what the investor know about the company past. Second, what the investor know about the company present. And third, the investor expectations about the company future. And the residual value model does just that by representing the value of a company as first the book value per share plus the present value of residual value. What is the residual value? The residual value is the net income of the company minus the cost of equity multiplied by the previous year book value per share. You got to be very careful when you apply this model, otherwise you might get a wrong answer. So we are going to use the same type of model we use, the same type of financial modeling design we use for Tesla. A very dynamic model that allows you to flow to different sheet nicely, a model which is pretty good for presentation. And we are still, for this exercise, going to use three scenarios. The only difference with what I'm going to do today and what I did with Tesla is that we're going to introduce what-if analysis for key variable to allow ourselves to form an opinion, a strong opinion regarding the valuation of a company. So first of all, we're going to forecast key variables. And for the residual value model, key variables are the book value per share of the company that needs to be forecasted, the net income of the company, i.e. the income statement of the company that needs to be forecasted, and the cost of equity. So we are going to forecast the income statement of the company and the book value per share of the company and the book value of the company under the best case scenario. So under the best case scenario, I made the assumption that the revenue of the company will grow at the 3-year compounded annual growth rate of 43%, starting from 2018. And using that growth rate, I am able to populate the remaining cell of my income statement. I'm able to populate the remaining cell of my income statement. And considering that the forecast of the income statement is usually pretty simple, when you have the first line, the revenue that is forecasted, you can simply represent the remaining line of the income statement as a proportion of the total revenue. However, it is always important to make some adjustment. And for Array Technology, I'm going to share the adjustment that I made. First of all, we're going to consider the cost of revenue. You will notice with me that from 2020, the proportion of the cost of revenue has been, as a proportion of revenue, obviously, the cost of revenue as a proportion of revenue has been increasing from 2020, probably due to inflation. And I expect that this condition will remain until, under the best case, at least 2024. So from 2022 to 2024, I will represent the cost of revenue as at least 90% of the total revenue. And from 2025, we will revert to the pre-COVID relationship, which was about 77% of the total revenue. So having that said, we can populate the remaining cell. We are going to do the same for the line contingent consideration. The contingent consideration for added technology represented two elements. One was the earnout, and the other one was the tax receivable agreement. The earnout has been paid, and the remaining element is the tax receivable agreement that I expect to be paid. That the tax receivable agreement, obviously, I expect the charge from that element to lose in importance and to be almost insignificant around 2030. I'm not going to have the time to explain exactly what the tax receivable agreement is, but it is important that whenever you review the remaining line of the income statement, you do it first in line with what the industry within which the company operates says, and also what the management say in the management discussion and analysis. That's publicly available data. When this is done, I can move to another line, which is, for instance, depreciation and amortization. You can see that from 2028, the charges from depreciation and amortization has been decreasing, but I am not going to make the assumption that they will continue to decrease. I will say that if the revenue of the company needs to grow, investment will be needed. So I'm going to keep the 2021 value the same over the investment horizon that we determined, right? You can obviously have a different assumption. When this is done, we have the remaining line of the income statement, and our income statement under the best case scenario says that the company will be in the position to generate about $13 per share in 2030. So now we move to the forecast of book value per share. So this is the one that is a bit tricky because it is very difficult to forecast a certain element of the book value. However, I think under the residual value model, the main change in the book value comes from the retained earning affected directly by the net income the company generates. However, I decided to make a provision for the additional paid-in capital, a variable that I noticed that was coming a lot. So I said from 2023, I will make a provision about 75 million per year for the additional paid in capital. And this value that I got, which is about 192 million, was my estimation for the additional paid in capital using the last quarterly statement that they've just published. And using, obviously, the net income that we have forecasted, and by populating this cell, this is our ending balance of book value per share that we will use in the model. So this is our book value that has been forecasted over the investment horizon that we determined. So we will do the same. We will do the same thing on the base case scenario. And under the best case scenario, I made the assumption that the revenue will be growing at the rate of about 34%. And this rate is determined using the 1-year growth rate from 2029 to 2020. And using that assumption of about 34%, we can populate the remaining line of the revenue. For the cost of revenue, the same assumption is going to remain intact as in the best case scenario. However, I will make a slight change by saying that I expect the current relationship between the revenue and the cost of revenue to extend to 2025 instead of 2024, right? That's the year I expect the current inflation to last to 2025. And the remaining assumptions obviously will remain the same. So this is our income statement under the base case scenario. We are going to use the same assumption for the book value per share. The only key variable here is going to be the net income under the base case scenario, which will populate the book value to allow us to determine the book value, the ending value of the book value per share under the base case scenario. We are going to do the same under the worst case scenario. And under the worst case scenario, we will determine, I will make the assumption that the revenue will grow at the rate of about 14.76%. And this is determined using the 2-year compounded annual growth rate of about 14% starting from 2019. And using that information, this is what we get as the first line of revenue. Now, for the cost of revenue, we're going to keep the same assumption as in the best case scenario, meaning that the existing relationship, which is that the cost of revenue represents about 90% of revenue, will be in place until at least 2025. The remaining assumption will be the same. So this is our revenue forecast, and we have our key variable net income that is available to us. And for the book value per share, the net income will directly flow here because we're not going to make any assumption for any dividend that is going to be paid to the shareholder. We're going to assume that the net income all the net income will flow to the retained earnings. So this is what we get. So having forecasted the book value per share and the net income under all our scenarios, now what we need is to determine the cost of equity and the long-term growth rate. I decided to use two different values for the cost of equity. The first goes from 2022 to 2030, and the second goes from 2030 to the foreseeable future. Now, regarding the risk-free rate, I use the current prevailing risk-free rate, which is about 3.25%. Regarding the equity market return, I determine this equity market return by evaluating the index within which our technology is the other technology index, if you want, which is NASDAQ composite performance after the period of crisis, such as the one that we are currently living. For instance, I evaluated the performance of NASDAQ after 2021 and after 2028, and I found 9.46% as a representative of what we can expect from 2022 to 2030. And the current beta of RA technology is about 2, and that allows us to determine the cost of equity to be about 15%. Now I will use the same approach for the risk-free rate. I will use the long-term risk-free rate, which is available to be about 2.85%. The long-term equity market return and the market return for RA technology is NASDAQ composite from 1971, which is about 9.78%. I also made the assumption that the beta for our technology is going to decrease to be equal to the beta of the market, and that allows us to determine the cost of equity to be about 9.78%. Regarding the long-term growth rate, I made the assumption that it will be about 3% in line with the OECD forecast for the economic growth. Now, having forecasted all our key variables, now we move to the determination of the fair market value of the company. But in this case, I decided to use a what-if analysis using the change or the interaction in the change in the key variable here that I determined to be the cost of equity for the first period, 2022 to 2030, and for the second period, 2030 to a foreseeable future. And first of all, we have our market value here of about, so when I determine the residual value, the market value of equity, the fair market value of equity, using the variable that I forecasted under the best case scenario, I have about 26.8, but ignore that value because we will use the what if analysis to form a better opinion of what we believe is the fair market value of the company, because it can be different depending upon what you use for the cost of equity for the first and the second period. So now I will change the cost of equity using this variable that you see. I will change the cost of equity for the first period from 9.67% to about 19.67% for the first one, and for the second one from about 4.78% to about 13.78%. And this is all the values that we get for the fair market value of the share of the company using different interactions of the cost of equity. And as you can see, all the green value represent the prices that are currently superior to the share price of the company, and the red value represent the prices that are below the current market value of the company. I think that when I completed this, the company was trading around $22, I think. We are going to do the same exercise using the best case scenario, using the base case scenario, and using the base case scenario, all the green, as you can see, represent the prices that are higher than the current market price, and the reds are the prices that are that are below the current market price. We are going to use the same approach using the best case scenario, and these using the worst case scenario, please. And these are the prices that are below the current market price of the company. And here, the ones that are above the current market price of company. So having all these prices under these scenarios and under these interactions of the key variables, what is my opinion regarding the fair market value of the company? I personally believe that the fair market value of this company is between $30 and $47. How do I get $30? I get $30 by averaging all these prices. Under the best case scenario, I will sum all of this. I will determine the average price under the best case scenario, the average price under the base case scenario, the average price under the worst case scenario, and using that, I will find about $32.47 to be the average price. Now, what about the 47? The 47 is the value that I first found for our technology stock when I was using my model around, I think, January and February, when I tweeted saying that all those believing that $10 is the fair market value of our technology are wrong. So this is the estimation that I had using my own model. So I believe the fair market value of our technology is between $30 and $47. The current market price is about $22, which means that our technology is currently grossly undervalued. This is what I believe is the fair market value of the company. It is highly likely that you have a different opinion regarding the fair market value of this company. If that is the case, the first question that I would like to ask is, what is the investment horizon within which your valuation applies? And the second thing that I would like to ask is, what are the expectations backing your valuation of the company? If you cannot provide this information to me, I can't take your valuation serious. I shared my work with you. I hope you enjoyed it. I seriously believe that our technology is undervalued. So if you like my work, do not forget to like and subscribe. And for business, do not forget to contact me. You can contact me, my information.